All right, let me get this right. Sell-offs and record highs all in the same day. Let's talk about what's going on. Major indices tally worst session since April 21st as borrowing costs tied to long-dated debt touch levels not seen since late 2023 after a weak 20-year treasury bond auction. Now, why does any of this matter in the first place? Bonds are boring, right? Well, bonds are facing a few problems right now, and we'll talk about how this impacts the stock market. So the first way is the bonds are facing an issue. So bond prices are going down, and to entice people to buy these bonds, yields must go up. So bonds are weakening. There are weakening demand for US debt, and there are a few different factors for this. Moody's downgrading US credit from AAA to AA down one notch. Then in the debt market and in the bond market, there are a lot of overseas competitors because across the board, we've really been seeing these bond yields rise. So why would you pick the one that just got downgraded credit-wise from Moody's? And this will be all three credit agencies, large credit agencies downgrading US debt. The other ones are a lot older, but this was the final one to do it. And there are other good competitors out there. So all eyes aren't just on US treasuries as they were. And then the aftermath of April 2nd, when we got an announcement of all of the crazy tariffs we were going to get. That could have left a sour mouth in many countries' mouths. The second thing bonds are facing is that there are growing concerns over the budget deficit. That was already a problem. And then throw on top of that Trump's multi-trillion-dollar tax cut proposal via this big, beautiful deal. And the tax cuts will look very good for stocks in the short term, or look good for stocks because they boost by encouraging consumer spending, and this is the biggest part of the economy. The current proposal increases projected budget deficits by nearly $3 trillion through 2034. Now, these budget deficits will require the government to sell more bonds to bridge the gap between the amount it collects in taxes versus how much it actually needs, because it's not going to make everything it needs from taxes, right? So it's going to have to raise debt, and then they sell these bonds and they pay the yield. That's kind of how you get sucked into this, right? Now, whenever the supply of something goes up as demand is staying the same or weakening, that's bad for pricing, right? Now, they're also facing we kind of talked about the sour mouth from April 2nd's tariffs. Well, tariffs are still an issue because it gives this, right now there's this fading of recession fears. Maybe not as much to yesterday versus today, because you know how this market's moving, but the walk back on tariffs was actually a good thing, because now that kind of drives demand a little bit, and people are all right, the prices aren't going to be as high right after they just got done front loading tariffs. So that could be a good sign. Lower prices in a way, because the tariffs aren't as high as they were. Now, the second thing involving tariffs is that there's this persistent inflation anxiety about how tariffs will impact pricing. I just seen another industry I wasn't really thinking about that's about to get impacted by these tariffs that they were talking about will be raising prices soon, and that is the auto insurance industry. So auto insurance premiums as replacement costs are pushed up from these tariffs. Then another one is another insurance, homeowners insurance, due to home building materials and furnishing costs increasing. Now, they expect that these increases will really hit by the end of the year. Most people will start noticing them, and insurance experts expect that Americans will likely reduce their insurance coverage going forward. Today, we've seen the 30-year treasury hit over 5% and the 10-year treasury over 4.6%. Now, what these yields really mean is that borrowing costs are much higher, they're going higher, and this is bad for two things. Really the same thing. Businesses. And what do businesses do? They issue shares usually, some of the large ones. And when you buy a stock, you're buying ownership in the company. They're bad for stocks if they're bad for business, because the business isn't doing as well. They can't borrowing costs are much higher than they were. So just think about that. And then something else we got today was earnings. We got earnings from three big ones where consumers usually shop: Target, Lowe's, and TJ Maxx, which is like a clothing store. Not Ross, but Marshalls and TJ Maxx and a few others. Now, what we've seen is that Target missed. It fell by revenue fell by 2.8% year over year, and it missed expectations by 24.2 billion. They named tariff uncertainty, lower consumer sentiment, weak demand for discretionary items, and boycotts due to the DEI. And they said all of that stuff in that basket are what affected the store sales they seen. They cut full year profit outlook, so guidance isn't looking too good. And they're also saying they're hinting, but they're trying to do it like in a whisper, like, hey, we're gonna raise prices. So what they say is they may increase prices where necessary, but they'll try to keep them as small as they can. Because if they just come out and say, yeah, we're beat up too, we're raising prices just like Walmart, they're already missing, and that's not going to look good for store sales if they're already missing. So they want to deliver that as peacefully as they can. Some of the spots to consider would be produce, just from Canada and Mexico and South America. We could see some prices there, and there are a few others, and especially if it comes from China, like toys and stuff like that, prices could increase there. And I started thinking about, could we live through Target like disappearing one day? Who knows how that could happen? I heard somebody saying that this Target miss, and saying that they expect things to be pretty bad for the store and how the consumer chooses to spend their money at them, being not as big of a deal to the broader economy, just because Target's not doing well enough at keeping up with Walmart and Amazon. They're not doing the online fulfillment stores. They don't have the Target Sprinter vans delivering right to your house. Yeah, you could order it and go pick it up in the parking lot, but they're not really thriving on the fulfillment side of it. So some people are completely blown off Target, but Target shares sold off. Also, TJ Maxx, we got that store, and they beat earnings per share by, they came in at 92 cents of earnings per share, and we're only expected to come in at 91 cents. They flagged the second quarter, though, that earnings could be softer than expected due to these tariffs. So they're like, hey, like, we expect it to get bad, but we still think we're going to do pretty well. So they maintained their forward outlook. So that was good news. This stock also sold off. Then we got Lowe's. Lowe's is a Home Depot competitor. This company deals more so to DIYers, and they're a much smaller company, which we just mentioned. They beat earnings per share and came in at $2.92 versus expected $2.88. And they said, although near-term uncertainty in the housing market headwinds are a thing, their outlook is still positive, like Home Depot. And they actually beat earnings. Home Depot missed. They do foresee, they did mention discretionary spending being down, and that's usually where people borrow, and borrowing costs are higher. So they don't expect to see a lot of drive and sales from that, but they do see and they actually mentioned they don't see broad price increases at all, and expect that the smaller projects will continue to thrive. Now, something happened today. We got a new all-time high, and I just kind of gave it away. Bitcoin. Why did Bitcoin hit a new all-time high today? I think this could be to a few different things. It got very close to $110,000. All right, chart, come on, load up so I can show them. You can see right here though, 109,400. All right, right there, boom. I'd pull up Weeble, but it kind of makes my computer lag just recording, and I got some other programs going. But what we see though is Bitcoin new all-time high despite all of the kind of bad news people seeing in the stock market, right? And with the treasuries. But I've thought about that. Well, we just talked about the Genius Act getting that advanced, right? And that places regulation around stable coins and further solidifies cryptocurrency into the economy. So that's good for Bitcoin. Another thing that's good for Bitcoin in a way and gold would be US credit getting downgraded and a weak treasury option. Things are going kind of tough in America. I want to get away from it, but I don't want to bet on the euro. I don't want to bet on the yuan. Trade wars, right? They're all kind of impacted. So Bitcoin is completely out of that system, along with gold. Now, I'm not going to say it's not going to be impacted at all, but just kind of thinking about all that we're getting. When did this even happen? I think the bond thing was around one. Has it got the time that happened? I think it was around like one-ish. Could have been insiders. I don't know. But that's just interesting. Like, just think about it. Getting away from the dollar. So it bounced right off of the 2.18 trillion market cap. Wow. How much money is that? Like can you even imagine $2 trillion? Wow. So what's next? Well, there's a lot of downside people starting to hedge for, right? Because we're already testing new all-time highs again in the stock market. It's pretty much been up for 6 days. Yesterday it broke that 6-day streak. But what problems are there really to be hedging against in the stock market right now? Well, one, consumer sentiment. We got tariff negotiations going on, and how volatile can those be? Economic reports come out daily. Fed speakers, we're going to talk about this here in a bit. Interest rates still being high, so what is the Fed talking about they're going to do with these interest rates, and where are these bond yields going that impact interest rates? And how resilient are these corporate profit margins? Can we see deflation and start seeing these profit margins really start to dwindle and go down? That wouldn't be good for stocks because companies are making less money. So there's a lot of different problems and risk out there in the market, especially when we're nearing all-time highs again, despite all of that list of problems that are currently out there circulating. I seen an article talking about how S&P 500 option hedges for the month of September were being bought up, and it's kind of noticeable to where everybody's starting to think about it. And just to point out, what are we expecting to happen in September? CME Fed Watch tool. Fed Watch. We're watching the Fed, right? A lot of people think the Fed will cut for the first time, and that actually went down a little bit in September. That's when the market thinks we're going to see our first Fed cut of just a quarter percent, so 25 basis points. And they got these hedges conveniently around September. Interesting. And right as Walmart announces laying off 1,500 people to cut costs right now. And then hedge funds, their gross leverage, which is the borrowing cash to boost returns, is now at a record high in short positions according to Goldman Sachs. And these are both towards financials and biotech. And I kind of thought about this while getting ready to make this video. In financials, with higher rates, you'd expect financials to do good, right? But if people are broke and they're complaining about where the economy is, and now people starting to get announced that they're getting laid off, they might not be spending money as much. Now there's that buy now, pay later, and that kind of helps it out, and people will go into debt on those. Who knows how all that performs though? Do they pay that kind of stuff back? But how does the Fed really feel right now? Well, there's a couple things that the Fed's mentioned that I've read today. First, that there's this growing share of lending outside of the US traditional banking system. And the Fed doesn't really have a way to directly impact this with their monetary policy, raising rates, lowering rates kind of deals, talking about talking up the market, talking about down the market. Now, this can really, in their opinion, in the Federal Reserve's opinion, heighten possibility of accident happening. because a lot of this activity and financial stability depends on smooth operations of short-term funding and markets like the repurchase agreement or repos, where firms borrow cash by exchanging treasuries as collateral, and then they bet on futures betting against those positions. So it gets really technical and more than I want to go to in this video, but it's kind of risky, right? And a lot of the lending going on right now is by these hedge funds or non-bank entities. And the Federal Reserve doesn't really impact those. So they're just saying like, hey, that's kind of risky, and us as the Federal Reserve needs to start thinking about what can we kind of do to help that if something were to happen from it. Now, this article right here, we got 3 Fed speakers this week so far. Well, we've gotten a few more, but this article is talking about 3, and it's San Francisco's Mary Daly, Cleveland's Beth Hammack, I think is maybe how you say that person's name, Atlanta's Raphael Bostic, and they revealed that there's no recession in the forecast, but there's not a cut either. Things aren't really going terrible right now. The consumers still staying strong. The job market's pretty strong. They're reinforcing their wait and see message that they've had for a while. They want to wait till the dust settles, get more clarity on how Trump's fiscal policy will come in and what all his incentives and decentives will be. And the downgrade also raises questions, they say. So Beth Hammack came out and they revealed a few different scenarios that they see playing out. The first is that tariffs act as a one-time price shock that weighs on growth and implications for the labor market. And I wrote this down, and thinking about that, it made me think of, okay, growth could kind of struggle, labor market kind of struggle. That would probably be a time to cut rates. But if it's just a one-time price shock that weighs on growth, maybe not. Like, we're probably good. So either cut rates depending on how bad it gets or not at all. And that supports the wait and see right there, right? And supports them waiting for a while. The second is that businesses start slowly embedding these tariff costs into prices, then inflation could stay elevated for longer, requiring higher rates. So then writing that down, it made me think of higher for longer. Like, all right, inflation's a little bit more sticky than we thought. We're going to have to wait this out. We want inflation down to our 2% target. It's not there yet. So we're going to wait. They might not raise rates, but I mean, you never know. But they might just hold rates higher for longer. So pretty much where we're at, instead of even cutting in September. And September's 2 meetings away. Now, the third scenario she sees playing out is that both inflation and unemployment worsen at the same time, creating a difficult trade-off between its 2 mandates for the Fed. Labor market, or good economy, good labor market, and keeping inflation in line. Stability in the job market and inflation. But that made me think of stagflation, and that's hard for the Federal Reserve, right? Because if inflation's high because of tariffs maybe, or whatever the reason, inflation and tariffs, I mean, tariffs impact inflation. So let's just say inflation's high and unemployment's also high. Like, what do you really do about that? Like, that's kind of hard because they want inflation to come down and they want to keep stability in the job market. But would lowering rates help out with inflation? That would drive demand, right? So that's why they say that's pretty hard for the Fed. And then what Beth says is that I am a person of action, but right now I think the best we can do is sit on our hands, pretty much, to sum it up. Then Bostic was more definitive. I don't have a recession in my outlook, he said. He noted many business leaders are holding off on big investments until they get more clarity on trade policy, immigration, and fiscal priorities. And the bones of the economy are sound. Mary Daly said her economic outlook isn't gloomy either, but she warned against treating forecasts as gospel and said the Fed needs to be honest about what it doesn't know. Tariffs are still playing out, businesses are adjusting at different speeds, consumers are more tapped out than they appear. What do y'all think? Market participants may want a timeline for rate cuts, but the Fed isn't offering one. For now, officials are saying watching carefully and waiting for a signal worth acting on. Interesting time, isn't it? So they don't really want to come out and say, hey, we're planning on cutting rates. We think it's going to get bad. That could forecast that they see a recession coming out and happening. And then what that also causes to happen is like the market believing them and then self-fulfilling that. And then it happens faster and maybe worse. So they're on this plane, trying to land this plane, and they want to do it just right where like it's really the plane's on fire kind of, but they want to like they don't want to overreact and like crash it and kill a whole bunch of people. Like that would be the hard landing scenario. Deep dirty recession, it sucks. Tons of people stop spending money. Tons of people lose their jobs. It gets terrible for everybody for a long time. But they don't want to like never land either, because that wouldn't be good. But I mean, consumers keep spending, inflation keeps going, the economy keeps expanding. But how does that really help? Like they want off this plane that's on fire. They need to put the fire out. I hope y'all like this analogy. So they want to like land it just right to where like it don't even like click your neck a little bit when you like land. They want to do it just right and have a soft landing is what they call it. And that's pretty much where they time everything just perfectly, cut rates right when they need to. The consumer does well. There's not this recession, and all of that's completely avoided. But with all of this stuff happening in the market, bond auctions coming in weak. Higher borrowing costs because these bond auctions are weak. Because the yields went up, right? And that influences the risk of lending money out to other people who don't print their own money. They work for a living. That makes them more risky too. So when they go get loans, that's harder for them. Tariffs, raising prices, shocking supply chains. That's not really good. So then stocks, I mean, they could go down because of lower demand. People just not spending money because of these tariffs being high. And then stocks kind of go down, and it's like, man, like I just lost all my savings, all my retirement. And that's not good. So you just kind of throw your hands up in the air and you're like, what do I do? But the Fed can't do that, because then it's like, oh my gosh, the Federal Reserve Bank don't know what they're going to do. So it's just an interesting time. And then Bitcoin, new all-time high, just while all of this is happening. Interesting time to be learning, y'all. Hope this video is valuable. Have a great night.